Over the last year, macro themes have dominated the headlines, creating significant market volatility in the U.S. and abroad. Global markets are clearly at a crossroads, reflecting concerns on inflation, interest rates, slowing global growth, and geopolitical uncertainty in Europe and Asia. U.S. equity markets have given back some of the strong performance of the last few years, as investors fear how aggressive the Fed will need to be to bring inflation under control while still engineering a soft landing for the economy. As we look ahead to 2023, we see a very different backdrop than we had this year. 2022 was characterized by high inflation, resilient consumer spending, lingering COVID disruptions, and aggressive Federal Reserve policy. In 2023, we expect inflation to moderate rapidly in the first half of the year, but remain elevated relative to recent history. The Fed should slow the pace of rate increases, and the direction of monetary policy would become much more data-dependent as recent rate increases work their way through the economy. Ultimately, we see Fed actions taking a backseat to company fundamentals in the coming year. With economic growth slowing, but the likelihood of a deep structural recession being low, it is more likely we will see a pause than a pivot in monetary policy. The focus for U.S. equities will be on profit margins and earnings, as the lagging effects of Fed rate increases take hold on economic growth, consumer demand, and pricing power slows with inflation. In 2023, we believe investors should focus on high-quality companies levered to durable secular growth themes. These businesses often have market-leading positions, strong financials, and balance sheets that give them the ability to invest and grow through the economic cycle. We see the relationship between growth and value shifting back to high-quality growth as the economy slows. At a sector level, we continue to take a long-term view. We think technology, healthcare, and select financials are well positioned to benefit in the coming year. In the technology sector, our focus has been on software over hardware. We continue to like the software industry and see it as the largest beneficiary of digital transformation sweeping through every industry. Valuations have compressed significantly in the sector, but fundamentals remain strong, creating an opportunity for investors with a long-term view. The healthcare sector is one area that has performed well in recent months. We see healthcare as having a great combination of growth and stability, backed by a large multi-year growth trend of increasing healthcare demand globally. In the financial sector, we're cautious on the core retail banking sector, but generally positive on many payments and financial services companies. We see the long-term path for the financial sector being one that is much more data-driven and personalized, creating opportunities for new entrants to grow rapidly. Despite the market volatility, we are finding opportunities in companies that we see as long-term winners in very large growth markets. Technology, healthcare, and financials are all areas of opportunity. The market is discounting growth, and while the current environment is challenging, we believe this is where alpha is generated by taking a long-term view and looking out beyond the next few quarters to position our portfolios for the next decade.